Hi all, welcome back to Appleby Academy's classes. So in this video, we are going to discuss about capital budgeting decisions. So when you're just going through this particular area, as we know that we are discussing this particular area under the unit business finance, and you can every time expect question from this area. While we discussed about the most important areas to be studied for the exam, we already discussed or we already focused about this particular topic, capital budgeting. And for this exam also, for June 2025, here again we have a question from this particular area, and now it's a match the following question, and list 1 says about the different types of capital budgeting techniques, and list 2 is about the explanation which is related to that. We can say that it is 1 and 2, like option 1 and 3, it is something related to its equations, and 2 and 4 is related to the basic function or basic concept related to that particular technique. Okay. So anyway, this topic is very important for every exam. This is a topic which is always focused from this particular unit. So when you are just going through this particular area, you should have a proper idea is what do you mean by capital budgeting and what are the techniques related to capital budgeting, and also you should know about the equations and calculations related to each of these areas. So first of all, as we know that capital budgeting, it's a long-term decision. We are taking a decision for a long-term period, and it is like it's a combination of two words, which is capital and budgeting, right? So it's about spending a large amount of expenditure. It can be for a purchasing of fixed assets or equipments, or repair of fixed asset to equipment, or research and development, expansion. For all these purposes, you can use this fund. So that is actually called this capital budgeting. And when you are just making a plan, like if you are spending a whole amount, or if you are spending for some long-term purposes, we will call it as capital expenditure. And if you got some plan related to this capital expenditure, we can term it as capital budgeting. So it's a process of planning which is used to evaluate the potential investment or expenditure whose amount is significant. So as we know that here we are investing a huge amount of fund, it is very important that you should have a proper analysis about whether this investment is good or bad for the organization. So you should have a more potential related to that. So that we are using a number of capital budgeting techniques for taking this capital budgeting decisions. And as we already considering, this type of process or decision is irreversible. Why it is known as irreversible? Because as we are investing a huge amount of fund, it is not easy for you to reverse the same process easily. Is that possible? We are building, we are making a building, and later that you are deciding not to do so. So that will again cost you, or that will again make much more costlier. Okay. So it's very important decision, and that's why it is mentioned as which is irrecoverable. That means you are not able to reverse it easily. Okay, so that point is also very important. And for making this decision, we have both traditional and modern techniques. When it comes to traditional techniques, we have payback period, ARR, or accounting rate of return. And coming to modern period, we have net present value, internal rate of return, profitability index, net terminal, and discounted payback. Okay, so now we are going to discuss about the techniques which got already asked for the question. So the first one is about payback period. So what is this payback period? From the name itself, we are able to understand that it is about calculating the period by which you are able to recover your initial investment. That means for a particular project, I am investing 10 lakh. So according to this method, you are calculating by how many years I will be able to recover this initial amount, that is 10 lakh. Okay. That is actually we are calculating under the head of payback period. So it is the time period required to earn initial investment of the project or investment. Okay. And when you are considering about two projects, which one you will go for if you are going through this payback period? Let's say if project A needs 5 years, that means if you are investing in project A, it will take 5 years to get back your initial investment. And in case of project B, if it's your payback period is 6 years, which project you will go for? You should go for A, because there you will receive your money within 5 years. But if you are going for project A, you will take 6 years. That is additional 1 more year will be needed for in the case of a project B. So always you will go for the shortest duration period. Okay. So that's a case of payback period. It's a very common method that we are using in case of payback period. I mean for taking capital budgeting decision. Now it's about profitability index, which is also known as desirability factor and benefit cost ratio. So profitability index is a term that we are using commonly. So you should also be aware about the other terms, desirability factor and benefit cost ratio, because for exam they can also ask about desirability factor. So you should be able to identify that desirability factor and profitability index are same. Then only you will be able to answer the question easily. So we are mostly using this profitability index in case where the investment figures are different. That means if project A, for investing in project A you need 10 lakh, for investing in project B you need 12 lakh. So the investment amount is different. In that case, to get into a better decision, it's always better to go for profitability index. And when you're considering the equation for profitability index, sum of discounted cash inflows divided by initial cash outlay or total discounted cash outflow. As it is a modern technique, we will take the discounted amount, and you can say it's about inflows by outflows, or inflows by outflow means it's an initial investment that you are making. Okay. Then if you are finding out this profitability index, and if you are getting a value of more than 1, which means that particular project is acceptable. So if you are getting a value which is less than 1, which means your initial investment will be more. That means you are not able to generate enough inflows from that. In that case, you should reject such projects. So you should accept a project if its profitability index is more than 1. Okay. And next is IRR, or internal rate of return. So internal rate of return is something which is, we'll say something related to NPV, because IRR or internal rate of return is considered as a rate that we are calculating, and by that rate, or at that rate, NPV will be 0, or you can say that IRR is the rate at which present value of cash inflow is equal to present value of cash outflow. So if we are finding such a rate, okay, by which rate these two amount will be equal. So that point is known as, or that ratio, or that rate is known as IRR. So NPV shows the net present value of cash flows of a project at a predetermined rate, but it does not show the rate of return from the project. So given investment figure and the expected inflow of the project, it is possible to find out the return percentage. So if you are going through internal rate of return, you will be able to identify by which rate you can make this present value of inflow to equal to present value of cash outflow. So the point that should be in your mind is that IRR is the rate at which net present value is 0 or profitability index is 1. So why you can say that profitability index is 1? See, profitability index means it's about, we are making the combination between inflows and outflows. So if both these are equal, like if inflow is 50,000, outflow is 50,000, what about your value? Say example for inflow I am taking as 50,000. So 50,000 by 50,000, which is 1. So IRR is the rate at which NPV will be 0 and profitability index will be 1. And finally, net present value. In case of net present value, first of all, management is fixing a cutoff rate. That means the minimum rate of return that the company is expecting from this particular investment. And using this cutoff, they will calculate that means they will discount. They will find the present value of cash inflows. Okay. So the future inflows, that is profit before depreciation but after tax of the project, have to be discounted to find out the present value. And one more point you have to keep in your mind, that in case of net present value, or in case of except ARR, accounting rate of return, in almost all the cases we are considering profit before depreciation after tax, profit before depreciation and after tax. In case of ARR, we are considering the profit after tax, after depreciation. Okay, just keep that also in mind. And now coming back to our question, I am going through the list too, and I will read the first one. Ratio of present value of inflows to investment. So we are considering a ratios, and we are considering the present value of inflow to investment. So you can say that it's a present value of inflow to initial investment. So which one is actually connected with that? We know that it's profitability index, right? So you can actually match C with 1. Okay. So after getting this idea, you have to go through the options, and you need to identify the option where C1 is available. Okay. Anyway, the next one, rate where net present value is 0. Where that net present value will be 0, as we already discussed, it's a case of IRR where NPV is 0. Moving to the third one, present value of inflow minus present value of outflow. Inflows minus outflows. where we are considering this situation, where we are taking this difference inflows minus outflows. We are actually taking that in case of net present value. In case of net present value, we are actually taking the difference between inflows and outflows. Okay, so inflow minus outflow. That's why we said that IRR is a rate at which inflows and outflows are equal. As we know that, as we already said that IRR is the rate at which NPV is 0. When NPV will be 0? When you are taking this difference, inflows and outflows will be equal. Inflow 50,000, outflow 50,000. So 50,000 minus 50,000, 0. So we are taking the difference between present value of inflow and outflow. And finally, time to recover initial cost. That is something related to payback period. Okay. Anyway, we identified that C1, B2, A3 and D4. So when you're just going through the options, see, as we discussed about A3. So there are two options related to A3 and when you are coming to D4. So A3, D4, there is only one option like A3, D4 and the correct answer is option A. So maybe for a match the following question, it will not be like you are able to identify all the options, but you will be able to identify at least two. You will be able to connect at least two of the options. Then it will be easy for you to arrive at the options, because with that you can eliminate the options, and with that will help you to identify the best appropriate answer related to the same. So as I already mentioned, this is a topic which is very important. Even for the next exam, you can expect a question from this particular area. So you have to make sure that you are just going through this area and you are studying the various techniques, including its equations. And as we know that for this exam they asked you some equations, so for the next time they can actually ask for some numerical questions as well. So I hope this video will help you for your preparation. Thank you and happy learning.